Good afternoon, everyone, and thank you for joining us for another Tuesday class. Today, we have a basics presentation for you. So we're going to talk through a guide to building true tax-free wealth through self-directed IRAs. My name is Brianna Clayton. I am an IRA specialist with Quest Trust. I've been with the company about 3 years, on the IRA specialist team a little over a year now. So I'm going to talk through some of the mechanics. We'll let you know what types of accounts can be invested, some of the investments, as well as some of the restrictions that go along with that. Now, we do have our lovely moderator, Sarah Shellum, here with us today as well. I highly encourage you to put any questions you have in the chat box. We will answer them as we go. Hopefully, I answer your questions throughout, but if there's anything unanswered, I will leave a link for you at the very end to schedule with one of our IRA specialists here at the office so we can talk through any of those pressing questions that you may have. But before we get started, we always want to talk a little bit about who Quest is, what it is that we do, and how it is that we can come to you today through this educational platform. First, we are currently the largest operating self-directed IRA custodian in the great state of Texas. I'm coming to you from Houston, and we actually have a Dallas and an Austin office as well. So we have our corporate headquarters in Houston. Across the country, however, we are not just limited to our client base in Texas. We have 20,000 active clients across the country. So you are not limited. Just because our physical offices are here does not mean you cannot get started on self-directing with Quest Trust as well. As of today, we have about $2.1 billion in assets under our administration. This includes both cash and non-cash assets. Across the 3 offices, about 100 employees. I think it's actually a little bit over that since this slide has been updated. And what's important here, and what I always really like to highlight, is a third of the employees that you speak with on an everyday basis are Certified IRA Services professionals. This is the CISP exam for those of you who are not familiar, meaning that a lot of the individuals who work here, once they hit a certain threshold, are required to sit through this week-long exam to go through the topics and teach and learn on what they talk to you about on an everyday basis. And I think that's one of the things that truly make us unique. Now, knowing that we have about $2.1 billion under our administration, about $400 million of those assets is sitting in undirected cash, right? These accounts are self-directed. A lot of people make the decision to move over to a self-directed vehicle, but they're really just looking for that opportunity. That, or they started to make money back on their investments and they're waiting for the next alternative investment opportunity to come up. So this is an opportunity for those of you who do have deals and are looking for the cash, potentially syndicators, whatever side of the line you may fall, we can certainly help out. Now, if you are familiar with our classes, you're very familiar with this disclaimer as well. A Quest Trust company does not provide any form of tax, legal, or investment advice. We are also not permitted to endorse any services or investments. So we always highly encourage your due diligence, and which is why we put on these educational courses. So you can get to learn a little bit about what you can and what you can do, some of the tax code that we're really pulling these guidelines from, and also some of the asset classes that you could potentially get involved with, and the industry experts who can teach you as well how to get involved. Now, the term self-directed IRA, and this is really a question we get all of the time, is truly just a marketing term. It just lets you know that your custodian is going to allow you to invest into the broadest possible spectrum of investments. So at Quest, we focus on private assets. That primarily can be real estate, and that's a lot of the time what we see. However, you really have anything that's not openly traded on the public market available to you as an investment. So no legal distinction between a self-directed IRA with Quest, and then think of a traditional or Roth IRA at Fidelity or Charles Schwab. The IRS really does not see these two as legally distinct. It really comes down to your custodian and what it is that they specialize in and will allow you to invest into. So some of the main, and I apologize, I think my screen might be cutting this off a bit, but this first benefit that I want to talk through is diversification. So a lot of clients, and I think the number comes down to about 85% of people with a retirement plan have funds in the public market, working in stocks, putting it in bonds or mutual funds. And so being able to move some of that money over to the private market and invest into things they may know a little bit better, like real estate or a syndication, or potentially even private lending, will allow them to not have all their eggs in one basket. And given the way that the market can be very volatile, this is really a benefit that I think a lot of our clients talk about when they're making that decision to move it over. Now, tax savings is something that you're going to get whether you're investing on the public market or the private. Tax savings just comes down to the retirement account that you're investing out of. So, for example, and we'll talk through some of these accounts as well, a traditional IRA is a pre-tax account, meaning that you're potentially taking a tax deduction for putting money in it, and then over time, whenever you're ready to pull it out, you'll then pay the taxes on that. So you're not accruing the capital gains in the meantime. Now, one of my favorite benefits to talk about is social investing. And a lot of people are very curious about this one, but ultimately it boils down to you having a lot of control over the investment. So you're really being able to choose the property that you're purchasing or investing into, choose the contractors that you're working with, and ultimately allowing you the control to pump money back into your local economy. Even though you may not be able to benefit from this right away, your local community can. And so being able to pump some of that money that you have that may be sitting for you in an account, working in the market, but putting it now to work somewhere where you can actually see that benefit. Now, this also, I think, kind of goes into investing in what you know best. Being able to pump that money into the local market also allows you a benefit to see what you're doing, to see that change actually take place. So you're really able to specialize in things that maybe you've been working on outside of the IRA for a number of years. A lot of our clients did start in real estate. So they're real estate investors outside of the account, and now they're wanting to move these investments that they're so familiar with, that they're so comfortable with, and put them into an account that they're going to be taking with them throughout their entire retirement. And so these are really some of the main topics that we touch on in a primary consultation. We ask, what are your goals, and where would you like to see yourself in the end? And so we can talk through these situations and see how these benefits can help you now and also in the future. Now, like I said, there are a number of different self-directed accounts. We primarily say IRA, and so the most common portion of our clients are investing through either a traditional or a Roth IRA. So that traditional IRA is typically when you're moving over from some 401k plan or employer plan in general. A lot of the times these employer plans are contributed to with pre-tax dollars. So if that's the case and you're wanting to make this movement as a non-taxable and non-penalized movement, you're going to want to open up that same tax style account that you already have. So your pre-tax 401k will then be rolled over into a traditional IRA, again, non-taxable, non-penalized, because these are the same tax style plans. Now, for a Roth IRA, it operates differently. So if you have a after-tax or a Roth 401k, you can get that into a Roth IRA. If you have another Roth IRA at a custodian, you send it directly to a Roth, non-taxable, non-penalized. A lot of you may be familiar with conversions, and that would refer to when you're putting these pre-tax dollars and you're converting them to a Roth IRA, which is also an option. I'll talk through what the mechanics of that look like a little bit later in a real life case study. So I think that kind of helps you get a better picture. But ultimately, and one of the main factors I think that go into deciding whether you want to invest either out of that traditional or out of the Roth or potentially both is the long term. A traditional IRA, because a tax deduction is being taken when you put the money in, over time, whenever you do hit retirement age, which the IRS says is currently 59 and a half, you can start to pull the funds out of the account. This will not be penalized because you've hit that retirement age, but you will be taxed. You'll be taxed at whatever your current income tax bracket is. So if you're thinking about that, ultimately, this will be beneficial for you if you do expect to be in a lower tax bracket in retirement. Now, for a Roth IRA, it's going to operate opposite. In this instance, you're not taking a tax deduction necessarily for putting the money into it, meaning that the taxes have been paid on the money that you're contributing to a Roth IRA. And over time, these funds are going tax-free. Now, there are some stipulations to tax-free. You typically do have to meet some requirements, but once you hit the requirements for the Roth IRA, then you can start to take out everything you've made in the account, everything you've converted, everything you've contributed, tax and penalty-free to you. So the question ultimately boils down to, do you pay taxes now or do you pay taxes later? We have a lot of great classes on these topics. So as we go through the types of plans, I will link you below to a few of the classes on Roth conversions, HSA and ESA accounts, and things of the like. So I do highly encourage you to take a look at our YouTube page, some of the videos we pre-recorded, a lot of really, really great information there. Now, some of my favorite accounts to talk about certainly have their caveats to them, but they are the employer plans. I think that these may be on this side fairly popular, or at least growing in popularity because of the benefits that they can offer to small business owners or self-employed individuals. So the most common account type, the SEP IRA. Simple IRA, not as common, but for this one, you have a lower contribution limit than you may for your SEP or your solo 401k. The solo 401k account is another popular account. It has its own distinct advantages, some that I'm happy to talk through with you. For the purposes of time, we won't jump into that just yet. But again, we're going to link this class right here. Please go ahead and watch it. If you are a small business owner or a self-employed individual and you're looking to maximize the amount of money you're putting into an account, then this is a really great video to talk through the mechanics of these three accounts and see what may fit best for you and for your employees. Now, since the passing of Secure 2.0 at the end of last year, you're now able to make both traditional and Roth contributions to all three of these plans. Prior, you were only able to make these traditional and Roth contributions to a solo 401k, but they've opened that floor up a little bit to the SEP and the simple IRA. Sarah, actually our moderator today, wrote a really great article on the Rothification of the SEP and the simple IRA. I highly encourage you to check that out on our website. Now, specialty plans, these are going to be the most underutilized accounts here. Now, a health savings account may be something that you're already contributing to, or your employer is already contributing to where you currently work, or maybe you have a previous plan. If you are currently contributing or your employer is currently contributing, you could potentially move that account over and self-direct it. Yes, a health savings account, just like a Coverdell education savings account, just like a traditional IRA or a Roth IRA, can all be self-directed. All of these accounts can be put into real estate. So one of the benefits of that health savings account is what we like to call the best of both worlds. This means that whenever you're putting money into the plan, you can potentially take a tax deduction for doing so. Now, you're taking that tax deduction when you put money in. So if you're logicking that out as if this was a traditional IRA, at some point you may have to pay taxes on it. Now, that would be true if you were not using the distributions for qualified health expenses. In the instance that you're contributing to a health savings account and only distributing the funds out of the account into your personal bank for qualified health expenses, they come out completely tax-free. So that's really what we mean when we say the best of both worlds. As long as you're utilizing those tax-deferred dollars for those qualified expenses, it's coming out to you completely tax-free. So it's a very unique benefit that that health savings account has. Now, these have lower contribution limits. The Coverdell Education Savings Account, for example, is $2,000 per child per year. So this is not going to mean that if you have a singular beneficiary and you set up two ESAs, that you can contribute $2,000 to each. If it's for the same individual, $2,000 is your max for the year. So it's obviously fairly low. And we'll talk through some of the strategies on how you can still utilize these low dollar accounts for these types of deals that you may be interested in. And again, just a really interesting video on the fact special accounts for special expenses. You could potentially be paying for your health and your education expenses tax-free. Just a small thing very quickly, the Coverdell Education Savings Account, you're not typically taking a tax deduction for putting money in. So it doesn't have that same best of both worlds factor, but you can still utilize this account, grow it through an investment that you're familiar with and that you know may have potentially higher earnings than the market does, and utilize those for qualified health education expenses. My apologies. And so these are the plans that we hold here. And a question that we receive, I would say, probably about 5 to 10 times a day whenever you receive the application is, I don't see the word self-directed on here. You see traditional, you see Roth, you see SEP, simple, HSA, but you don't see the term self-directed. That is because all of these account types can be self-directed. So really, you're looking to open the plan that you are planning to utilize either to contribute to or to pull over from a similar account type. So it's not going to say self-directed on the form, but it is implied that every account through Quest can be self-directed. Now, something I alluded to a little bit earlier is that these accounts, not only can they be invested individually, meaning that a traditional IRA can take title to a property, it can be the lender, but it can also partner with other IRAs. And so we'll talk through some of the restrictions in a bit, but in this instance, when you're partnering, your IRA and your spouse's or your children's ESA are on the same side of the line. And so this can be done in a number of different cases. The individual vesting, meaning that just one IRA is the initial investor. This is what the typical vesting is going to look like. Sorry about that. Quest Trust Company for the benefit of John Smith, IRA, and the account number. This means on any paperwork having to do with the purchase of an investment, you're going to list the individual vesting. This is to show that you as an individual are not the investor, but your IRA entity is. The IRA has its own EIN, it has its own address, it is a formal entity. So when you open the account and you create the IRA entity, you need to be sure that on any paperwork having to do with the IRA and its investments, you are listing that formal title. Now, going back a little bit to the partnered vesting, this means that you and your IRA and another IRA, another HSA, another ESA are partnering together on a deal. This will require that you are dividing that interest up amongst the amount that each account is able to put up. So on a $100,000 deal, if John Smith's Roth can put up $50,000 and Jane Smith's IRA can put up $50,000, then you're going to want to make sure that that is listed in the vesting as to an undivided 50% interest. And again, we'll talk through some real life applications of that once we get to the case study portion of the presentation. So with this in mind, there are a lot of great things you could do with the account, but we always want to touch on some of the restrictions. It is very important to note that whenever you are transacting with a self-directed IRA, that the IRS does have code specifically to let you know what is acceptable and unacceptable in the account. We separate these into three main categories: people, transaction, and investment restrictions. And so we're going to briefly go over what this means for you. First and foremost, one of the most popular topics whenever we do go through these consultations is who is a disqualified person and what can they not do with or for the IRA. So the first people restriction that you'll need to know is that there are people who are not able to benefit from or enter into transactions with your IRA or other qualified retirement plan. These people come down to you as the account holder. And note that there's a line here. You are on this side, your IRA on this side, because you as an individual are a taxable entity. The IRA is a non-taxable entity. So you're going to want to avoid getting into transactions with the IRA, essentially being on that separated side of the line. We talked about being on the same side, being on opposing sides of the line, buying, selling, trading to could be potentially seen as prohibited. And so with that in mind, here is a very complicated chart, but it essentially talks about the individuals and the businesses that could potentially be disqualified from entering into investments with your IRA. So just to kind of summarize who those individuals are, the account holder is disqualified, their spouse is disqualified, their children, their parents, and their spouses. So think if you're looking at a family tree all the way up and down that ladder, your lineal ascendants and descendants and their spouses will be disqualified from entering into transactions with the IRA. That will also extend to any company that these individuals may own, control, or be highly compensated by. So this chart is a very complicated way of telling you that, but it truly goes into a lot of very specific and important detail for those who are looking to get into transactions that may have specifically to do or have some relation to a company that your son or you or your husband or your family may actually work at. So take a look at this. I'm happy to send it out to you. It's very important that you look at these details, potentially even read through the tax code. We're happy to share those publications with you and see really where you fall. And if it's a gray area, it just may be worth considering avoiding that or bringing it to an actual attorney, having them look over the investment themselves, break down these details from a qualified professional who can tell you if you should move forward with that investment. So these people that I mentioned, yourself, your spouse, children, parents, these cannot buy, sell, trade, loan, or extend a service to the IRA. This means that if you personally own a property, your IRA cannot buy that property from you. You also cannot, your IRA cannot sell that property to you as an individual or anyone in your family. You cannot loan out of that account to yourself, to your spouse, your children, your parents, right? So they do disqualify these individuals from essentially benefiting from the IRA prior to retirement, because ultimately these accounts were created and they're looking to grow for your personal retirement. And so the IRS will place these restrictions on it in order to show that you are not benefiting now and that you may potentially be benefiting later. Right. So a lot of people say, well, this is going to benefit me because if my IRA is making money, ultimately I'm making money. Well, that's really not what they're talking about. They don't want you paying personal expenses for an IRA asset. That could be you extending a service. So this can be, as you can see, direct or indirect, meaning that maybe you aren't living in the property your IRA owns, but maybe you're renting it out to your daughter or your son. That is an indirect benefit. So you're going to want to avoid these little microtransactions that could potentially be prohibited by the IRS. A really great class that I actually point a lot of our clients towards is the prohibited transactions class. It's going to give you a great analysis on what you can and what you can't do. Some really interesting case studies as well are on that page if you want to take a look at some interesting transactions, but kind of zoom into them and see exactly how they're structured. Now, investment restrictions, super simple. There's just two things. One, life insurance contracts. The IRS says you cannot invest into someone's death. Fair enough. Secondly, collectibles. Now, this can be a number of different things. Probably the primary question that we get asked is artwork. It's also alcoholic beverages. So those are probably the two most common questions that we receive on this portion is really, can I invest into artwork? Unfortunately not. It's really anything with that subjective value you want to avoid investing. We do have a requirement as your custodian to report to the IRS on a yearly basis what your account value is. So you're going to need a hard valuation of some sort that we're able to bring to them. So in this instance, these items, essentially collectibles, vintage cars, things of that nature, are not an allowable investment within the IRA. So we got through the fun part, what you can't do. Well, what can you do with the account? Well, while real estate is really the primary investment that we see come through, it's by no means an exhaustive list here. Real estate is going to take on a number of different forms, private entities actually being one of our most popular investments as of late. Private entities are most of the time some form of syndication or joint venture. And so we see that because these assets are extremely passive, that a lot of the times IRA clients will tend to put their money towards those types of investments. They typically have that 3 to 5 year hold. So it really puts them in a good position as far as, hey, I can't touch this money anyways for 5-10 years. In the meantime, you can grow those funds through something like a private entity, which again, mostly comes down to those syndications. Now, one that I want to talk about, and these are the three main transactions team we have here. So if your investment falls into one of these three categories, you are going to be assigned a specific representative who specializes in that specific asset class. So for example, our notes department will process a number of different items, most commonly mortgages. You can invest into an unsecured note. Obviously, highly encourage your due diligence in any aspect that requires money to go out unsecured. Convertible notes are also very popular if you're investing into some form of private stock or at least receiving stock for the loan at some point in time. So like I said, by no means an exhaustive list. This is the most common items that we see come through. We do process hundreds of investments on a weekly basis. So these are just kind of the categories we see them naturally fall into. The only item that I would say on here that we see a little bit less of is really going to be unimproved land, just not something that we always see come through. But everyone in our real estate, private entities, promissory note department are very well versed in the documentation needed, how the transactions worked, and they're going to work with your seller, with your borrower, with your title company in order to make sure that these transactions go through as smooth as possible. So we are going to talk just very quickly about how you're able to do this. Typically, opening the account, that's the easy part. We can get that open for you within 24 to 48 hours. I'll talk through some promotions that we're running as well through the tax filing deadline for those who may be interested in getting started quickly. So 1 to 2 days, we have your account open. Great. Now we need to know how to fund your account. Will you be moving over from a 401k? Do you currently have an IRA you'd like to transfer over? Or will you be making an out-of-pocket contribution to the plan? Those are your main 3 options. And so we're going to assign you an IRA specialist in order to help you through the first, the second, the third steps of the process. So they're going to help you fund the account. Once you locate your investment, you'll just need to bring us the actual agreement in writing. That can be a subscription agreement, a purchase agreement, a promissory note. But whatever it is that you're bringing to us, please note that your IRA needs to be listed as the investor, as the subscriber, as the lender, the buyer. So we are not able to complete the paperwork for you, but we do review this internally for a compliance review to ensure that your IRA is the investor on the paperwork, and 2, that your IRA is not gauging into anything that would be considered blatantly prohibited. We do have some forms that you'll complete. And again, we'll apply this to a real life case study. We'll talk through some of those forms, what that transaction will actually look like for you. Once we have the actual investment paperwork, we have our internal forms, we're going to go ahead and fund the investment. Now, our funding times are always 24 to 48 hours. So this is 24 to 48 hours from when we have your investment documentation, we have our internal form, we're going to complete our review, finalize any details that need to be done, again, with your title company or your borrower, and then we're going to send those funds out via wire, check, ACH, whatever your preference is, directly to the investing party to complete the actual purchase. From here, the IRA will remain open to receive any income back from the investment. We'll provide our delivery instructions to whichever party will be making the payment. They can make those payments right back into your IRA. You'll be notified every time those payments are made. And then from there, you can choose to invest in a new investment, leave the funds for the next one, or potentially transfer it to a brokerage IRA in the meantime. So now we're going to talk kind of through some real life case studies. I think whenever you are going through this process, something really important is to really put it in perspective. What exact steps need to be taken? What does a deal typically look like? And how does this apply to other clients who have already gone through this process? So we're going to start off with a little bit of a longer case study on a rental property. Now, this was 2 gentlemen. We're going to name them John Wood and Jay Wright for the sake of anonymity. But essentially, they wanted to purchase an office condo, and they wanted to do this within their SEP IRAs. Remember, these SEP IRAs are typically for small business owners or self-employed individuals, so they'll allow you to funnel a large amount of money into them than you really would with your personal plans like a traditional or a Roth IRA. So they each decide to transfer $150,000 from their brokerage IRA to their Quest SEP IRA to purchase the property. Now, they make an offer to purchase the property, and on the contract, this offer letter is going to show that John Wood and Jay Wright are both putting up money for the purchase. On our end, we will have a form that we'll need you to complete. We call it our direction of investment form, and this is because we need the client's direction in order to invest. Note that these are self-directed IRAs, so bringing us the contract simply won't always provide what we need in order to approve it. We'd like for you to complete our internal direction of investment form. Let us know how much we're sending out, what the property address is. If you have a title company that you're working with, we'll ask for your signature on that form, as well as your read and approved signature on the contract itself. This read and approved signature acts as your approval on the actual contract, because ultimately Quest is going to be signing off for the IRA itself. So we're going to want to see the client's signature of approval stating that we have read this contract and we approve of Quest to execute it and complete this transaction. So now we have the actual contract in hand, and along with this, they are needing to send out a earnest money deposit of $10,000. Because this is a 50-50 investment, there's going to be $5,000 sent out for each account to complete that earnest money deposit. Now, when it comes to the closing process, John and Jay are going to be the ones to review and approve all of the closing documents, and then the title company is going to send over to Quest for signature. So you notice that they still have a role here where they step in and they review those documents, make sure everything is good as approved between the two parties, and then have the title company or whoever this middle person may be send these documents over to Quest so we can ultimately sign off on behalf of that IRA. Once the signatures are completed, we're going to wire the funds from each SEP IRA to the title company to close. Again, this specific investment was split 50-50, and so that should be reflected on that contract as well. So the title company is then going to record the deeds exactly as signed, and they're going to be the owner of record to Quest Trust Company, FBO, John Wood, SEP IRA, account number, as to an undivided 50% interest. And if you're splitting an investment, that's a very important part of that vesting. We need to know exactly how much ownership will be awarded to each individual based off the amount that they were able to put up for the purchase price. Now, in this instance, note that whenever we talk about extending a service to an IRA-owned asset, that could potentially be, as an individual, you working on that property personally. Something that you will always want to avoid when it comes to the rental properties in particular is collecting these rents into your personal account. So a lot of the times we see that our clients prefer to have some middle person in place. That way they can have their rent sent there. They can ultimately pay these expenses. And so a property management company will take on that role. They'll allow you to have those rents paid directly to the property management company. The property management company then turns around and sends those rents back to the IRA. This will allow you to have the cleanest transaction in this instance so that you, as the IRA account holder, are not receiving those checks. You're not depositing any funds into your account. It's just going from your renter to your property management company to the IRA. Very straightforward process. So this is why they may want to do so. Another reason being that they want to find a good tenant for the property. They either may not have the ability to provide that time commitment, or they may just prefer to be hands-off in this way, where they'll hire someone specifically for the duty of vetting out those renters and finding an individual who would be good for their IRA-owned asset. Again, rents and expenses will all be handled by the property manager. Those expense requests can be submitted directly to us. We will process, again, 24 to 48 hours. That is always going to be our processing time frame when it comes to really any transaction. So your property management company will submit the request to us. We will make that payment to the property management company within that 24 to 48 hour time frame, or to a contractor, whatever the case may be. So they're able, at this point in time, once they found a renter, to have a positive monthly cash flow of $850. So 50-50, that's going to go $425 to John's IRA, $425 to Jay's IRA. These funds are tax deferred, meaning that when they go back into the SEP IRA, and we're presuming that this is a pre-tax SEP, because at the time that this was actually in action, there was no ability to contribute Roth funds to a SEP, right? So these $425 are going back into the SEP IRA tax deferred, and that means that there are no capital gains taxation on the income that they're receiving from this property. So 2 years later, the tenant that this property management company found offers to purchase this property directly from John and Jay for the price of $395,000. So they prepare a sales contract and they submit that to Quest. Note that they have their read and approved signature. So they've already read the contract. They have agreed to pay they have agreed to sell at that price point, and so they sign their read and approve. They send it to Quest, and they also provide a direction to sell letter. Again, we need the approval directly from the clients to transact in any manner. So this direction of a sell letter very simply just gives us their approval to complete this transaction on their behalf. Now, on the day of the closing, again, note that they have this oversight responsibility. They're reviewing the documents, approving that everything that is on these contracts was agreed upon between these two individuals and their buyer. We are going to sign off on these documents. We're going to forward them along to the company, to the title company, and then all proceeds after the closing costs will be wired back to their SEP IRAs 50-50. And so in this particular example, I do want to talk about what that return actually looked like, because I think it's really important to apply. And in this instance, they really had a very well set up investment. So the initial investment for each IRA was $125,000. Note that they moved over $150,000 each, but ultimately they only utilized $125,000 for the initial purchase price. So over the 26 months in which that property was cash flowing, they received $11,050 each. Now the gains from that sale, $62,500. They're looking really at what the proceeds are after the closing cost, $198,000 to each SEP IRA after the sale. That is a tax deferred gain of $73,550 or 59% over 26 months. So this is a really well set up investment. They really thought all of the micro transactions through with the property company, and ultimately got very lucky with a tenant who was wanting to actually purchase that property outright. But this is a really great example of things that are done on an everyday basis outside of the IRA and putting them into an IRA, allowing these funds to grow tax deferred. And in the meantime, you're able to still make these same types of investments out of the account and still see where you're able to move these investments into the account in the future. So these are two individuals who are already well versed with these transactions and have finally put them into an account where they're able to control it just a little bit better. And ultimately, they were able to benefit from that. So some key points to remember: there are no taxes on the gains that they received. They are tax deferred, so they can reinvest the full amount of their profits on the next deal free of taxes. Think of it similar to a 1031 exchange. However, it's not that same thing. We don't actually handle those here, but if you are familiar with that type of transaction, very similar to that, you can put all of the money back into the next deal, and they're not needing to pay any taxes in the meantime, right? They know that they're going to eventually pull the funds out in their retirement, and then they'll pay the taxes at that time. Now, if these accounts were Roth IRAs, Roth 401ks, ESA, HSA, and now a SEP Roth or a simple Roth, then the gain is tax-free forever. Note that one caveat is that you do need to wait for a qualified distribution, still requiring you to meet that age of 59 and a half. But ultimately, once you meet that retirement age, you've had the account and contributed to it for 5 years, you can pull all of the gain out of a Roth IRA, a Roth 401k, what have you, and those funds can potentially be tax-free for the rest of your life as you begin to make those distributions. Note that John and Jay are in full control of this process from beginning to the end, but Quest is the actual buyer and the seller of the property. So Quest Trust Company, for the benefit of John and for the benefit of Jay, we need their approval to make any transaction, but ultimately we are still going to be the ones to sign off on the documentation and send out those funds as needed. Note that them putting this money into an investment was not a distribution from the IRA. Their IRA made the investment. So the IRA simply just bought the asset and sold it later, but they were not taking a taxable distribution in order to make this investment happen. They had a custodian such as Quest be that middleman who can approve the transaction, review the paperwork, make sure that the IRA is the investor. And you've heard me say that a few times, but it is very, very key to these types of deals is that the IRA is listed as the investor. Now, note in this instance, this was a really great example of partnering. So you can partner with other IRAs or less commonly non-IRA money. So we talked about being on opposing sides of the deal and on the same side of the deal. And note that partnering is alluding to you being on the same side of the deal. And so in this instance, John and Jay partnered their SEP IRAs together. But let's say John did not have $125,000 in an IRA to partner with Jay. In this instance, John may have been able to have that $125,000 in a personal bank, a savings, a brokerage account that he wants to utilize towards the deal. So this $125,000 in one IRA and this $125,000 for a personal, for an individual, can be still partnered together on a contract. That does not change anything as far as the percentage of ownership. 50% of the income will still need to go to one party, 50% to the other, as well as 50% of all expenses are expected to be paid from each party as well. So if you are designating a percentage of ownership based off of that purchase price and what each party is able to put up, note that that needs to be followed through the entire lifetime of the asset. So all expenses, all proceeds need to be split in accordance with their ownership percentage. In the instance that you are allowing one party to pay over, let's say 80% of the expenses when they own 50%, that could be potentially a prohibited transaction. Because again, you want to prevent yourself from providing any type of extended benefit to an IRA-owned asset. Now, in this instance, they did hire a property management company. It is by no means a requirement. We actually have a payment portal built out for your renters. So in this instance, you could direct your renters directly to our payment portal, and they can make these direct payments to your IRA, no property management company involved. We'll also provide our delivery instructions, so if they prefer to initiate payment directly from their bank, they can do so. Property management company is just an option that some clients take because I think it's a little bit more hands-off, but again, by no means a requirement for you as an IRA investor. Now, this was a little bit of a shorter case study. Is that regarding an option contract and one of my favorite account types, which is an education savings account. So very straightforward. Andy has a good deal that's under option, and he has just recently opened up an ESA for his child, Audrey. And so what he does in this instance, he has the ESA opened up. He's made his $2,000 contribution to the plan. Now, the earnest money / option fee is going to be $100. And at some point in time, the option is assigned to the investor for $13,400. This is all going back into the ESA once that is done. And from here, if those educational expenses are coming up, then he's able to withdraw, and in this instance did, $8,500 from the account, tax and penalty free, to pay for tuition, right? Because remember, these education savings accounts are set up with the intention to utilize the funds and the growth of those funds for qualified educational expenses. So he is immediately able to take the funds that he received back from this option contract and utilize that to pay for his daughter's tuition. The rest is going to be saved for reinvestment. You can also reuse that for future educational expenses as well as college education. We're going to talk through Roth conversion. So we mentioned them a little bit earlier, a real estate flip with a Roth conversion. And there are really two instances in which you can do this. And the first, and what we're going to talk about today, is going to be the cash Roth conversion prior to the purchase. Note that that doesn't always have to be the case, but in this instance, this individual located a property that they wanted to purchase with their IRA. They have about $300,000 in a traditional IRA, and they've only just made their yearly contribution to the Roth. Right. So at this point in time, the contribution limit was $6,000. They have a $6,000 Roth IRA, a $300,000 traditional IRA. They've located this property. They know they want it to be an IRA investment. However, they also know that a Roth IRA grows tax-free, while ultimately in a traditional IRA, they are going to have to pay those taxes in removal. They expect that once they are able to flip this property, that they're actually going to make a fairly good profit on it. So what they decide to do is take $150,000 from that Roth or from the traditional and convert it to the Roth. Something very important in this process to note is that that $150,000 is going to be taxable income for you in the year that you convert. So whenever you are making this transaction, it is very important to consult with a CPA. And we always say that to make sure you're not pushing yourself into another tax bracket, right? Normally, this is just going to be taxed as your normal income. In the event you are pushing yourself into the next tax bracket, you could be paying more on taxes in that year. So just something to keep in mind, always a good transaction to consult with your personal CPA on so they can look at your full picture and let you know if that's right for you to do in this tax year. So in this instance, to purchase this property, the purchase price is $101,000. Again, they've made the conversion. The Roth IRA is currently holding $150,000. Now the rehab costs are about $55,000. Remember that they did contribute that $6,000 as their yearly contribution. So they have all of this amount sitting in the Roth IRA. They were able to properly flip the asset. Talking about what the actual timeline looks like here, the purchase price, whenever you are on this section, is about 30 days, right, to get that property under contract and the purchase completed. Rehab, as you know, can take anywhere from 60 to 90 days, potentially even longer in this instance. And then once they are complete with that, the selling process as well, 30, 60, 90 days, 100% really just depending upon your buyer as well as the marketing that's being put out to sell this property. So in this instance, they've located a buyer and the selling price is now $239,000. After the closing cost, the IRA, the Roth IRA, is going to then receive $69,000 back. So this is, or apologies, that's the profit that they receive. So $69,000 in profit goes back to the IRA. That means that this individual, within less than a year, was able to receive a 54% return on their investment. And the most important part, this is completely tax-free money. As long as they meet the qualifications in the future, they're going to be able to pull that $69,000 out of the Roth IRA and never have Uncle Sam touch it. So it's a very unique benefit and something, while underutilized, is not for everyone. Not everyone, most individuals who decide not to make a Roth conversion in this year are already in a high tax bracket and they don't want to add $150,000 or what have you onto their income. And that's completely understandable. In this instance, this client knew that they were going to turn this property around in a short period of time for a high profit. And so in this instance, it benefited them to make that extra $69,000 tax-free. And again, while not for everyone, it can certainly provide a benefit in the instance that you know for a fact that that investment may be cash flowing at a very high rate very early. And as far as that goes, those are the case studies I have for you. Before we move on into a few of the promotions, some of the events we have coming up, I do want to make sure that everyone's questions were answered. If there's anything that I can answer for you now, I encourage you to put it in the chat. I will just go on a little bit with what we are currently doing here at the office. We are preparing for tax filing deadline. So that's coming up very fast. You've got about a few weeks to get your contributions in, a little bit less than that actually. And so we're helping you out. We are, one, rewarding your deposits, or we can waive your account opening fee. So for those of you who are looking to either send money in for a new investment, or you're making a contribution to a plan in which you can contribute a high amount for the previous tax year, for this tax year, then you potentially would benefit from the rewards for deposit. Depending on which tier you fall into, once your account is funded, we're going to provide you with a reward credit. This is a fee credit that can be utilized towards your first transaction, towards any administrative fees, or what have you. And on the other side of that, if you don't yet have that investment coming up, if you're not contributing within the $100,000 range, then we will waive our $100 account establishment fee for you so you can get started on contributing to those plans, opening them up, and preparing the vehicle that you would like to invest in the future. And so we have these two going on right now. If you are at all interested, please let us know. I will actually have a consultation QR code here for you in a minute. You can schedule through there with any one of our IRA specialists, and we can talk through what the mechanics of that account looks like. Now, this event is coming up for us March 30th. So if you are local to the Houston area, we have the Masters of Tax Avoidance Bootcamp happening downtown on Rice University's campus. It's going to be a really great event. We've got a lot of really awesome panels lined up and speakers to talk to you about some strategies and how to build wealth utilizing those strategies, some of the different asset classes you can get involved into, as well as some CPAs who can talk you through some of the mechanics of that as well. For those of you who are joining us for the first time, we do have our Self-Directed IRA Saturdays class every single week. And again, this comes from individuals, whether they're an IRA specialist or they're an expert in their particular asset class, syndicators, lenders, what have you, will come onto the platform and talk you through what those investment looks like, what the current market is, where they see that going in the future. So you're hearing from a lot of valuable education every Saturday to talk you through what you can do with the account. Even outside of it, a lot of these individuals are investors outside of the IRA, but they'll talk to you about how you can get it into one as well. And so one of my favorite events here is the virtual networking happy hour. This is the fourth Wednesday of every month. Essentially, this is a national Zoom call. And we'll host this Zoom call in order for individuals to get in front of either individuals with the money or individuals that have the opportunity. And so a lot of individuals come on here and they present the details of their opportunity to everyone on the call. They can share contact information and get in touch with people all over the country who may benefit them in their current investment strategy. As always, every class that we host here on Tuesdays, on Saturdays, is always recorded and we will post it to our YouTube page and our Facebook. So feel free to check those out as well. And I do see a couple questions here, so give me one moment to put them on the screen. Can a part of the rehab cost include payment to me, the Roth IRA owning, for managing the flip and being the general contractor on the flip? If this is your IRA, then you could not receive payment for that. In this instance, if this is a third-party IRA, so this is not someone in your lineal ascendants and descendants, no beneficiary to your IRA, then they can certainly make payment to a general contractor for managing that flip. However, if your personal IRA is involved as the owner, you would not be able to accept funds or payment for managing that flip. Thank you for your question, Toby. Christina, is it hard to get a non-recourse loan? I don't think that hard is necessarily the right word. There are absolutely lenders out there who will lend non-recourse to an IRA. We work with quite a few. And so I would say more than anything, what's important is talking to them, seeing what the terms of those notes are going to be and determining if that fits for you. I would compare it to getting a loan for a regular property outside of the IRA, right? So not in particularly hard. We work, again, with a number of lenders who do just that. And so it can be a firm, but it can also be a private lender. If you have a private lender in your network who is willing to lend non-recourse, then you can go ahead and take that as well. Just really depends upon the terms of the note and what you agree to move forward with, because I think that's ultimately what it always boils down to. And thank you for your question, Christina. If there are no more questions, or if you're a little shy, feel free to scan this QR code here. This will take you to an IRA specialist calendar. That way we can schedule a consultation, go over your personal situation, talk through how Quest can help you, maybe some of the mechanics of these deals as well, in the instance that you have something already in mind and you're looking to see if it's potentially applicable in the IRA. We are very happy to talk through that with you. And Christina, you cannot lend your personal money. If you're lending to an IRA, you cannot lend to your own IRA. If you have personal money you want to lend to, again, a third party's perfectly fine, but you personally could not be the lender on a non-recourse loan to your own IRA. I hope that made sense. And I'm going to leave all of this contact information up here for you all. This is going to have our Facebook, our LinkedIn. We post about our upcoming events there. If you ever have any questions, even right now, we have a full team of IRA specialists on staff who can answer those questions. Give us a call at 855-FUN-IRAs. Find us on LinkedIn, Facebook, and especially YouTube. That's where all of our classes go. We highly encourage you to reach out to us on there, ask any of the questions you have, and we'll be very, very happy to help you out. And at this time, are there any other questions for us? Has everyone been answered? I'm just doing a quick scroll through the box. I see they linked the YouTube page in there as well. So if you're looking to revisit this presentation, you'll be able to click that link and watch it from the very beginning. It's going to be posted on there for your viewing pleasure. So feel free to send that out as well. We do, if you register for these events, we do typically send you a link out anyways. So I would recommend if you see any upcoming events you're interested in, go ahead and register for it. We're going to send that link out to you after the fact if you were not able to make it. And Ivan, great question. Can I partner with my IRA on a deal? You certainly can. So in this instance, you would just be the individual putting up personal funds and your IRA putting up funds. But what's very important about partnering with yourself on a deal is that you're going to want to make sure that line that you draw as far as ownership goes is very, very strict. So if it's 50-50, you want to avoid allowing 51% of the income to go back into the IRA, right? Because that is a benefit that you're extending to your IRA directly. So that as long as you're being very strict with that percentage line that you draw on the front end, you certainly can partner with that deal. You'll just want to carry that percentage for your investment, for your income, and for your expenses through the entire lifetime of that investments. And then the second part of your question, my personal funds, or I believe that was meant to say, or an LLC I own, that's absolutely fine, right? If you are utilizing the funds from your personal, in your individual account or your LLC's account, that is okay. You just want to keep those lines strict. Whenever you are making these types of transactions, it is recommended that you have some form of attorney who's looking over those documents, keeping you in compliance. They should be able to draft up documentation for you and ensure that it is compliant with any IRS regulation or guidance that has been released on the topic. So while it can be done, there are just some very strict rules to it. So certainly get an attorney involved. I think it'll make you feel more comfortable with the transaction, but overall, it can be done. And thank you for your question, Ivan. Any other questions for us before I dismiss class today? I'll go ahead and close out. If you're still typing, feel free to do so. But I want to thank you all for taking the time out of your day to join us. Feel free to revisit the replay that will be on our YouTube, and we will see you next Tuesday. Thanks so much, guys.